We're back once again with another episode of What's on Your Mind. Welcome to all of you watching, and this time on the show, I've got Anthony Iser and Edward Shek joining me. Guys, thanks for coming on the show once again. It's great to catch up. Now, if we kind of take a look at the current market backdrop at the moment, we've seen volatility rise throughout October. The VIX is around the 35 level. There seems to have been a little bit of a de-risking associated with that across asset classes. And, some of this is obviously going to be due to ongoing COVID implications for various economies. We've got the presidential election next week, and we've also got earnings season coming up. So I guess quite generally, Ed, what are you thinking? What stage are we at now, and what are you thinking about going forward?
Yeah, so what's on my mind? Well, I suppose up to probably the last month, I think the rally off the COVID lows has been quite well understood. We know we've had a big liquidity event, huge stimulus, we've had tech adoption, tech disruption, markets being led by growth stocks, tech stocks, and it's all been fairly well understood. And in the last month, of course, we are getting a bit of divergence now. It's always a good time to stop and think as we're coming to earnings season. And we've already seen some good dispersion, whether you look at the Snaps versus the Fastlies, the Netflixes, and obviously with big tech earnings coming out this week. So I think we're in a holding pattern now. We've obviously got the election and COVID's reared its ugly head. When I think about what the long only fund managers are sort of thinking about as a position for the next 1 or 2 years, I think they really fall into two camps, one of two camps. One is the slightly more bearish group who are worried about the Japanification of the US, Western Europe, and effectively all developed markets. And the other more bullish view is that with a bit of fiscal stimulus or a large amount of fiscal stimulus, the elections come and go, a vaccine does come out, and then they're very optimistic that the world will, synchronize, in a synchronized fashion with what's happening out in the Far East, get back to a normal expansionary GDP trajectory. It might be at a lower level than what we entered coming into COVID, but that will be a good outcome nevertheless. So it's obviously quite a complicated subject, but Japanification, I'll break it down very simply. We know what we're talking about. We're talking about anemic economic growth, persistently low inflation, interest rates at or below zero or around zero. We've got expansionary balance sheets from the central banks, lower productivity, and even potentially an increase in zombification. So obviously Japan's had about a 25-year head start, and there are obviously many differences, but there are some very close similarities. The first being that monetary policy clearly stops being a real economic growth impetus. And as government spending increases, you actually see lower economic growth. And what we're really saying is this added stimulus is really just continuing to misallocate capital. So why with all the stimulus, fiscal and monetary, is there no inflation? So one argument is that all this QE doesn't actually lead to quality loan growth. Okay, so when the economy is over leveraged, banks, the financial system, are actually more reluctant to lend, and quality borrowers are actually more reluctant to borrow. So this misallocation continues. A lot of the liquidity finds its way onto the bank's balance sheets as reserves, which is obviously not good, or into the financial markets. And that's what we've seen clearly in the Western developed economies. So huge amounts of stimulus really just leads to an inflation of asset prices. So if inflation's a problem, what happens to productivity? Well, think about a central bank. In our lifetime, the central tenet's really been price stability and then full employment. What happens when there's no inflation and no sign of it? You obviously then start focusing on employment. So has there been no productivity growth in Japan? Well, there has. I mean, the manufacturing sector, they've adopted tech, a lot of automation, and by some metrics, Japanese manufacturing is still the most efficient on a per unit labor perspective. So the manufacturing sector has actually become efficient. but now only 1/3 of the workforce work there. 2/3 are in the service economy. Now, with Japan, with the cultural unsaid philosophy of looking after full employment and with open, obviously, government and central bank actions, they've tried to defend jobs. The result of which, of course, now 2/3 of the people work in the services industry, and they've been slower to adopt technology and cut the workforce. This has obviously caused a growing and lingering amount of large companies who are staying viable just with a plenty and abundant amount of debt and cheap debt, the zombie company. The Japanese society is happy, in inverted commas, with this status quo, rather taking a more sort of aggressive job cutting program. So now, of course, the Fed's going down that route, not worried about inflation because there is none and there won't be for years. So what do? They put pressure on the government for more fiscal stimulus and they try and defend jobs. So clearly the similarities are there. So it's obviously a complex subject and I've only touched on a couple of points. But if the Japanification plays out, what will that mean for the market leaders and the market as a whole? Well, I would suspect actually the makeup will look quite similar to what we have now. There will be pockets of growth and fast growing growth, and that will probably still be in the tech sector specifically. So you can take a bellwether like Microsoft and say, well, with the growth anemic in the background globally or in the US, more likely to be both, then if you're growing your revenues 10, 15 to 20% a year and you're trading at 33 times forward, that's okay relative to what else is out there. So I think if you are defensive, you clearly don't think there'll be a cyclical recovery, value is not going to re-rate, and you stay with what served you well from the COVID lows. Now, obviously, in the second camp, you think a couple of rounds of fiscal stimulus are going to support further growth. There will be a bit of inflation finally, and you rotate into the industrials, the cyclicals. Tech probably underperforms in the short term. That's what we really hope, and certainly the central banks, is unless these economies can really get up to escape velocity, where there can be some inflation coming through driven by demand, not necessarily supply. The only way the central banks can get out of, the worry of a monetary death spiral, where you're in so far, there's no course to, change course. And obviously there'll be no growth coming through. So I think that's definitely what the long funds are really thinking of. Now, this isn't really actionable stuff. It's just, the big macro factors that we all have to be aware of. So I think I'll pass over to you now, Chris, and we can get on to the more actionable stuff.
Yeah, I think that's a really interesting kind of long-term analysis of where we might be headed, and it factors into our shorter-term trades in some respect. But let's get to some of the stuff that's a little bit more kind of relevant over the next 3-6 months or so on. So are either of you thinking about election trades or anything like that, or is that not really on the radar?
Well, Chris, the election's obviously a huge topic in markets, and is, while there is, some data out there, it's obviously, a lot of it's very subjective and a very emotive discussions that people are having. And then you add in COVID on top of that, which again is a major impact, but you don't really know what's going to happen. You guys in the UK are in sort of self-imposed lockdowns in various parts. I've just come out of 114 days of 23-hour day lockdown. I've got the new haircut. I've got the US Masters shirt on to try and just inspire myself to get out on the golf course. And we've got very few cases and had sort of less cases than most people the whole way through. So we've reacted quite differently to the way the US is and the UK is. So it's very hard to put actionable numbers around what the COVID impact is going to be on some of these things. And it's the same with the election, as far as I'm concerned. So you can have a look at this chart here. JP Morgan's popped out their Biden basket versus their Trump basket. And and essentially it's just a little, marketing ploy for them, gets them in the newspapers. They've just whacked a bunch of stocks in there that don't really make too much sense. And the polls last time, while it was within the margin of error, sort of got it wrong. I don't really know what's going to happen this time around, and I'd rather be sort of agnostic about it. So what I've been thinking about is what sectors or what companies are going to sort of do well despite, whether there's a big blue wave or a red wave or there's a contested election. Where's a company that's going to sort of work its way through? So that's what I've been looking at, Chris. And I found one company I thought looks, pretty interesting. The ticker is SITE, SITE. It's trading around $123 at the moment. It's a $5.5 billion market cap, and it is landscape supply, wholesale landscape supply company operating all across the US. It trades at a fairly reasonable premium to the sector. PE 52, 50, and 41 for the next 3 years, and it's just a very interesting company for a whole range of reasons. So I'll just give you a few now. Firstly, the industry is massively fragmented. These guys are the biggest player in the industry by 4 times bigger than the second player. Yet they've only got 12% market share. So this is an old-fashioned roll-up story, and it can happen with dental clinics, doctors, childcare, where you've got lots of fragmented small players, and a big player comes along and rolls them up into one big company, and that's what these guys are doing. And it looks very, very interesting. The total market. Annual market is $20 billion. And like I said, they've only got 12% of that at the moment. It's a complicated business in one sense because you've got 120,000 different SKUs that they're selling. They've got thousands of suppliers and thousands of customers, but they're doing a very good job at putting all that together. And as I said, rolling up, making acquisitions. What have they made? 8, 6, 8, 13, 10, 4. So 49 acquisitions in total since 2015, totaling about $900 million in sales that they've acquired, a couple of $100 million in acquisition costs. And all that leads to is a company that's growing its earnings very, very strongly, compound growth of about 22% per annum over the last few years. But the thing that makes it most attractive to me at this point in time is, as I said, I want to be election agnostic, and I'd like to be COVID agnostic as well. So these guys, for the second quarter, which ended in June, they managed to increase their sales in that quarter by 9%, which is a pretty impressive thing to do during the worst of the COVID impact, or certainly the worst that we've seen so far. In the US, their gross profit was up 11%, EBITDA was up 16%, and they reduced their leverage ratio as well from 3.3% down to 2.2%. So everything that you would want from a company at any point in time, let alone during the worst of COVID. So sales growing well, up 15%. As I said, EBITDA is 22%, so some good leverage in the business as well. And the forecast is for that to keep going. So yeah, this is a company that I think looks very good. They've recently come out, reintroduced their guidance for 2020. As many of the listeners would be aware, earlier in the year when COVID hit, most of the companies out there withdrew their guidance because there was no clarity. These guys obviously feel very comfortable. They've reintroduced it, a range of 200 and 250 mil for EBITDA for 2020, which is a strong number. The results due out any day. So this is sort of Wednesday morning UK time. The result may be out by the time this goes to air. So we'll see what happens with that. but I suspect it should be quite good. But again, everything's, there's a lot of turmoil potentially in the market with the election, so we want to try and do something that or position this in a way that we're not going to get blown up if the result is wrong, or goes against what I'm thinking it may do, or if we see broader market turmoil as a result of COVID in the short term, or obviously the election, or as Ed mentioned, we've got all the tech companies reporting in the next 3 or 4 days. Their performance will be a key driver of the market as well. So we could go and buy the stock at $123. Alternatively, for about $10, you could pick up the January 125 calls, which I think is not a bad way of looking at this one. And in addition, if you wanted to fund that, a bull put spread, selling the 125s, buying the 110s for protection, because we'd never want to be selling anything naked, would get you about a $5 credit. So that's what I've been looking at, trying to find things, where I'm sort of pretty agnostic, because it's just, it's a tough time at the moment. And to Ed's point about the economy and sort of a split in views about what might be happening, one of the key drivers of that is just the disconnect between what's gone on with the real economy and what's gone on with markets. And we know a lot of that's been to do with the Fed coming in, huge support, one round of fiscal support. So if you have a look at this chart here, this is the disconnect between the S&P and the economy, GDP, and you can see it's never been bigger. So there's a few interesting things going on at the moment. One of the other things we've been talking about is buybacks, which have disappeared as you would expect. So again, this chart here shows you we were at about 200 billion authorized buybacks, as low as it's been since 2009. Yet at the same time, lots of companies are increasing their dividends. And again, here's a small list of companies that are doing that. So it's sort of pretty mixed at the moment, trying to find things that don't rely on one particular outcome or another. How are you seeing things? Is there anything that's been popping up on your radar?
Well, yes. There's no easy way for me to say this, so I'm just going to have to come out with it. Carnival Corp.
Hey,
Carnival Cruise Liners. $13. $12 billion market cap. $24 billion of debt. So I hear you say, Ed, so is this the company that has no passengers? I'll say yes. Is this a company that's just done a big capital raising and yet will still run out of money by August of next year? And I'll say yes. Is this a stock that's still on its arse at the COVID lows? Yes, again. So anyone in the ITPM fraternity and sorority, or certainly anyone who's done a mentoring program, has every right to say, no, Shecky, no, this isn't what we know. We're supposed to look at quality companies with good earnings growth, good management, identifiable catalysts, good time horizon, probabilistic price target, good payout ratio. And I shall say, yes, you have been taught well. However, give me time. Let's get the ugly numbers out of the way first. So 2017 to 2019, the company was having steady, if unspectacular growth, about 20% at an EPS level. Revenues are about 20 billion. We come into this year, revenue will be 5 billion, down 75%. So effectively, Q1 was effectively pre-COVID, and there's had no revenue for the last 3 quarters to the end of the calendar year. So it was making $4.33 2019. It will make a loss this year of $7.33. Net income's about minus 7 billion. And also it's increased its debt by 5 billion and increased its share count by 27 million shares to 717 million now. So it's horrific. So what's got me onto Carnival Corp? Well, I come in and I look for the next 3 to 6 month window, and I always sort of think, what could double? Where are the double baggers coming from? What could go up 50, 100, 150%? and what needs to happen for that price action to play out. So there's obviously a catalyst. It will be a vaccine. Now, whatever probability you attach to the vaccine, whether it be 20% or 85%, you can argue that the market's pricing this in. But I'm saying it hasn't in the bombed out travel and leisure stocks. Now, we're not talking about a cure, we're talking about a vaccine, like the flu vaccine. Flu kills 15,000 people in the UK every year, 60,000 in the US. Fit and healthy young men and women take the flu vaccine, still sometimes get ill. There's usually a new bad strain every few years, which tragically takes a lot more life, but we don't lock down the economy. So this catalyst is clearly my view that we will get to a point where we will live with COVID like flu, and the economy will open up and we get back to a level that will be the new post-COVID level. The catalyst is the vaccine, but I'm also talking about a liquidity event. When XLK sold off 40% on the COVID news, we didn't hear fundamentals being talked about for 2 months, and rightly so. Sold off 40% in 5 weeks, got half of that back in the next 3, and by June the 1st, we were back to flat. At that point, when the flow of funds starts to normalize, we then have a fundamental anchor, and then it's safe to come back into the water. So I'm positioning myself now in Carnival Corp. Now, the stock was at $50 pre-COVID. With the dilution from the extra debt and shares, you can argue that we should really use 42 or as low as 40, i.e. a 20% discount for the dilution that will come. So what we're really saying is, if it was $4.33 of earnings in 2019, for the same passenger revenue, that earnings might come down to, as low as 350. What I'm saying is that I think that if I give myself a 6-month window, when there is positive vaccine news, I suspect some bombed out travel and leisure could double very, very quickly, even before we look at who's booking cruises and the fundamentals. So that's the thesis. So when we look at the specifics, you could buy 17.5 strike calls for under $2 out to April. So your break even's at 19.5. So if the stock gets back to 35, which I think it could easily do quite rapidly, you're going to make $15.5 on a $2.5 spend. So that gives you a 6-to-1 payout. You can also obviously trade 2-for-1 at the money structures by April. You can sell the November 17.5, get yourself a small credit. Nothing happens by November, book that, sell December, so on and so forth. If anything happens, you obviously give away more upside than you would with an outright long or a vertical spread, but that's for you to decide. So this is a strange one, but we live in strange times. This isn't really a fundamental story. But I have to ask myself, if I come down into the office one day in the next 6 months and there's positive vaccine news on the tape, am I just going to say, wow, I didn't see that coming? Of course not. Now, can you argue it's priced in? As I said before, yes, you can. But I'm not saying that the market's going to go up and stay up. I'm not even saying you sell some tech short term and you buy some cyclicals. I'm not making a call on value. I've just identified what I think is a real opportunity, and I'm prepared to take the risk. In a portfolio of 14 to 16 positions, to have one position 6 months outright at this stage seems an acceptable risk to me. Because I think it's very rare in the market that you think there could be a real liquidity event that isn't going to come out of left field. And I'll say it one last time, I'm not saying I'm going to buy Cinemark, Las Vegas, Carnival, and sell Peloton, Zoom, and Teladoc. No, of course not. But I do have a plan. I'm happy to take one position now outright. At least it feels like the book has got some proper gearing to a vaccine hitting the tape. Do I have a list of favourites that I think have the most upside? Yes, I do. Do I have a list of stocks when the market settles a bit, which I think may be potential shorts? Yes, I do. So if Carnival's not for you, that's fine. However, what you must do is go through a vaccine list, work out what you think has the most upside. prepare for the event. And at the end of the day, you can sit and wait for the news to break, but believe me, the gap risk, these things could open up 10, 15, 20%, in which case the option price volatility in these names is going to explode. So all I'm sort of saying is it isn't for the faint-hearted, but we are always trying to predict the future. And I think this is a relatively low-risk way of getting your toe in the water and getting some upside risk. You have been warned. No tears if you miss it. Go on, book a cruise. Back to you, Chris.
Yeah, absolutely. That's a really interesting one to look at, and one that's obviously a little more risky. But yeah, I like the concept of allocating a portion, a small portion of the portfolio to something like that, so it's ready for this possible event. So really interesting that you've identified that. Gentlemen, it's been a pleasure this episode. Thank you both for coming on the show. Certainly looks like we've got an interesting few weeks ahead of us with earnings and presidential elections and so on. And it will be interesting to catch up with you guys in the weeks and months to come to see, to talk about what has unfolded over those weeks. But that's it for this episode. Thank you all for watching. Remember that if you do want to learn more about managing your own money and trading, then you can learn more at our website, itpm.com. I'll, of course, put a link below the video for that as well, so you can find that more easily. But yeah, that's it for this time. I hope you all enjoyed the episode, and make sure you join us next time for another episode of What's on Your Mind.